Hi students, welcome to Echo 342 lecture series, Macroeconomics Theory 2. I'm Ganiat Adejoke Adesina-Uthman, a professor of economics at the National University of Nigeria. Let's look at the course guide. The course guide for Echo 342, which is the second phase of macroeconomics theory, is a prerequisite um, course to Echo 341, which is macroeconomics theory 1, which is the first phase of the macroeconomics theory class. This Echo 342 course material is developed into 7 modules, and these 7 modules are broken down into different lecture series. What are the learning outcomes? At the end of this unit, you should be able to define and explain key concepts, aggregate savings, consumptions, and investments in national income accounting. Identify differences in circular flow of income, the 2, the 3, and 4 sector models. And also familiarize yourself with national income, disposable income, and per capita income. Have you ever wondered how countries measure their economic health? Why do policymakers debate GDP growth? And what does national income actually really tell us about a nation's health or nation's prosperity? This unit will unravel these questions and equip you as an economist with the tools to understand the heartbeat of economy, the heartbeat of an economy. Let's go into the concept of aggregate savings, aggregate consumption, and aggregate investment. The term aggregate means that we are looking at the totality of savings in the economy in a given period of time of 1 year in an economy. Same thing for consumption. The total household consumption in within 1 year in an economy, and aggregate investment refers to the totality of investment from the private sector and investment from the public sector within 1 year in the economy. So let's look at the component of circular flow. There are 3 components in the circular flow of income. In an economy, we have the government, we have the households, and we have the firm. And when you look at the relation between household and the businesses, households and government, and businesses and government, you will see that when households produce labor to the businesses pay back in terms of salaries and wages. And when these people receive this income, the household, they spend it on goods and services that are produced by the businesses. The businesses, after selling and buying, after making profit, also pay government taxes. Household also pay government taxes, and government in return is expected to provide amenities, give support to businesses, some of palliatives, some of subsidy in terms of bailout when there is trouble, and in terms of investment infrastructure. And so the household spending goes into consuming what the business produces. They get wages which they use to consume these products and goods and services produced by the businesses. And so businesses also make dividends, get dividends from their businesses. And they pay taxes to government, so also the household, like I've mentioned earlier on. And government in turn is to provide amenities that will make business to strive. So let's look at the classical and the Keynesian model in income determination. The classical economists believe that there are 2 factors, or there are 2 basic sectors, the firm and the household. That's why they believe that when we talk about national income, we are saying income is equal to consumption plus savings, or consumption plus investment. But Keynesian the Keynesian economists believe that the government is a component, is a sector that should not be neglected. And so they added the government sector. And the fourth sector model incorporated the external sector, which is the foreign component, the import and export. Let's quickly look at the component of the external sector in national income determination. When you look at this diagram, for example, it's showing us the import and export value of marble and other natural stones in Greece from 2000 to 2016. If you look at the blue graph and the red graph, you see that the blue graph represents the export and the red represents the import. Over the years in Greece, you see that the export is growing and the import is dwindling. So they import less and export more. And that is what is expected to get the next export, which is X minus N. That is, when you want to define X is export, goods and services sold to other countries, while M is the import, which means goods and services bought from other countries. So when you buy less and you export more, you are supposed to have what is called trade balance. When you say export minus import, we give you trade balance. The balance of payment should be surplus, should be in surplus and not be should be positive and not be negative. When it's positive, it's surplus. When it's negative, it is deficit. And this influences country's economic growth. It also influences the stability of the country, the health of the economy, and the strong will or the power of their currency. It also will affect policy decision making in the economy. So, like we have said before, classical model believe y equal to c plus I, while the Keynesian belief is equal to y is equal to c plus I plus g, and also adding the component of the external component, we have y equals c plus I plus g plus into brackets x minus n. This occurred because in 1930s, this way of thinking about the national income coming from two sector or three sector after the global economic depression became a thought that is not really welcome anymore. And so the Keynesian believe that the national income model being a linear summation of the three major sectors of the economy, namely the household sector, the business sector, and the government, which could be represented algebraically like we have seen below, is the best way to go. And so, what is the impact of this on the economy? When we have the foreign components incorporated, positive net exports will bring about a boost to the gross domestic products of an economy and increases foreign currencies reserve of the country. It will then strengthen the local currency of that country. Example, Germany's trade surplus support its industrial economy. The negative effect of a negative net net export means there will be a drain on the GDP growth of that country, because if export, it means they are paying more in foreign currency to other countries, and they are not attracting those currency back to their own locality. It may lead to currency depreciation. Of course, the power of that country's currency that imports more will continue to depreciate. That is what is expected. When you look at the US, it's 1% trade deficit, but it offsets its trade deficit with capital inflows. When you look at this diagram here, you see from 1992 to 2019, the US is having trade deficits in billions of dollars, and it's continuing to grow, especially between 2000 in particular to 2008. It went down a little bit and started skyrocketing again in 2020, 2010, 2012. And it has been like that up till 2019. When you look at the orange color there, it's showing the trade deficit uh, percentage of GDP. So the US is trying to, balance things up with capital inflow into that country, despite their balance of payment deficit. Now, let's quickly look at some other concepts under the national income accounting. We have national income, which is the total income earned by residents, GDP plus net foreign income. We also have disposable income, which is national income minus taxes plus transfers, what household actually spend or save. We have per capita income, which is the national income divided by the population of a country, and it measures the average standard of living of a country. If you look at the per capita income of the US in 2014, it was actually 46,032 cents. $40,000, 32 four and $46,034. That is the per capita income average. No, sorry. It is $46,049. That is the average for the US. Okay. If you look at this thing very critically, Nigeria is not there. So I want you to go and look for the per capita income of Nigeria, the real disposable income in Nigeria, and the household disposable income of Nigeria, and compare with some other countries that are listed here, not just the US. This is a classwork. Describe the circular flow and different models of it. I want you to define national income, disposable income, and per capita income as well. Okay, so you should be able to define different models that we have and their components algebraically. Let's look at the definition of national income accounting. It exclude non-market activities. That is a major limitation because household work and some volunteerism is not captured, and this can also be monetized as income or wages. It ignores income inequality, that is GDP divided by capital, uh, and that marks distribution. It fails to account for environmental degradation, such as pollution and resource depletion. Conclusively, balancing trade, investment, and external borrowing is crucial for sustainable economic development. A healthy economy, a prosperous economy, must have its external sector in national income accounting to have a mix of competitive exports, a stable capital flow, and prudent debt management. This must be combined together for a surplus balance of payments in an economy. And the external sector shapes an economic's national income positively or negatively depending on which side of the divide you are. Are you towards importing and not exporting to other countries, or you are even exporting raw materials? If your country is raw material exporter, then what do you stand to gain so much from foreign currencies? Now, please go to the group discussion forum, try and let us have the pros and cons of this question. Is GDP a reliable source of development? Please, I want your contributions on the discussion forum of the LMS for this course. In summary, we have seen the concept of aggregate savings, investment and consumption, national income, disposable income, and capital income. We have also discussed about injection and withdrawal in a country and the intervention of circular flow of income in an economy. When you look at the circular flow that I showed in the diagram, you will see what constitutes injection and what constitutes withdrawal in an economy. Thank you so much for listening, and see you in the next class. Bye.